So a lot of people don't know this, but there is actually quite a lot of stocks on Trading 2 and 2 that claim to pay you dividends every single month. And if that's the case, then you could use these stocks as a way to increase your dividends and generate a second monthly income. But after doing some research, it's very clear that we are talking apples and oranges, and that not all monthly dividend stocks are made equal. In fact, some have some pretty poor performance histories, but there are also some with good historical growth, one that's never cut its monthly dividend in about 20 years, and one that's currently paying around 12% in annual dividends. So let's take a closer look. Now just remember, I'm not a financial advisor and nothing in this video is financial advice or a recommendation. I'm just sharing some information, but remember to do your own research and consult a financial advisor before making any decisions. First, this list right here is all of the equities I found on Trading 2 and 2 that claim to pay a monthly dividend or distribution. And as you can see, there are quite a lot of them. So I've taken a bit of time to go through each one of them, and I've selected 5 for us to go through today that I think are a bit closer to meeting the type of criteria that I personally look for when I'm adding to my portfolio. Now that doesn't mean that my criteria will be the same as yours, so if you'd like, feel free to take a look through any of these in your own time. So let's jump right in and stick around to see the last ETF, which is currently paying a roughly 12% dividend yield or around 1% a month on average. Okay, so number 5, in no order, is Agree Realty or ADC. This is a retail REIT in the USA, and a REIT just stands for Real Estate Investment Trust, which is basically a company that owns loads of property, rents them out, and by law has to give at least 90% of their taxable income back to its shareholders like you and I. So Agree owns and operates a portfolio of around 2,700 properties leased to big sturdy retail names. And back in 2021, they switched from quarterly to monthly dividends, and since then they've raised their dividend payouts 5 years in a row. The current dividend yield, or how much they currently pay out in a year, is 4.1%. So if you put £1,000 in, historically that's about £3.40 landing in your account each month on average, and roughly £41 a year. So let's talk share price, because over the last year it's been pretty flat at 3.7%, which is not a lot. But for dividend stocks, we'll often look at the total return for a better indication of performance. And total return means the return an investment produces in all forms, including capital gains, dividends, and interest. And the total return for Agree Realty has been about 33% over the last 5 years. And in recent news, in the first quarter of 2026, they reported record acquisition activity and adjusted funds from operations being up 7.9% year on year. So it's a solid, boring, dependable starter, but boring can be good when it comes to monthly income. By the way, guys, remember that share prices and dividend yields change, so be sure to always check out the latest updated figures. Next is Realty Income, which is a stock I've held in my portfolio for a long time. This one is famous for monthly income, and they've literally trademarked the nickname the Monthly Dividend Company. This is another REIT with over 15,500 properties across the US, UK and Europe, rented to the likes of supermarkets and pharmacies on long leases. But here is the data on their track record. They've declared 673 consecutive monthly dividends. They've raised the dividend for over 31 straight years, making them an S&P 500 dividend aristocrat. And in June, they announced their 135th dividend increase since listing back in 1994. The current dividend yield is around 5.2%. So on £1,000, historically that's about £4.30 a month, roughly £52 a year. The share price is up around 11% over the past year, and the 5-year total return has been around 20%. Recently, they've updated their future strategy, and they've been pushing into data centers, which has been a growth market lately due to the ever-increasing demand from AI. And if you zoom out on the share price for this stock, it paints the picture of a history of gradual but long-term growth, which is something I tend to look for in my own portfolio. But before I get to the final 3, If you're looking to get started on your own investing journey, or perhaps even if you want to just open a new stocks ISA, well, Trading212, the sponsor of today's video, are offering all new customers one free fractional share valued up to £100 when you scan the QR code up here on the screen or click on the link down in the description below in order to help you get started. Alternatively, if you do enter the promo code CASH in the app within 10 days of opening your account and just deposit £1 into that account, you'll still qualify for that free fractional share valued up to £100. Now, back to the video. So next up for number 3 is EPR Properties, ticker EPR. This one is another REIT, but don't worry, it's the last one on the list. But this is a bit different because it's an experiential REIT. They own cinemas, water parks, ski resorts, golf attractions, the places people actually go out and spend money, and it's another one in my own portfolio. Now, because this is a company that requires people to go out en masse to their parks, back during COVID in 2020, they suspended their dividends when all of these types of properties were forced to close. But since restarting, they've raised the payout 5 years running, and in February they announced a 5.1% increase from last year's dividend. So currently, the yield is around 5.9%, and on £1,000 invested, that's historically been an average of 4.9% a month, or roughly £59 a year. The share price is up around 13.5% over the past year, and the 5-year total return has been about 65%, so a fairly strong recovery. Then they recently announced buying a portfolio of 7 regional amusement parks for $342 million, their largest acquisition since 2017. This personally has been one of my top performers, but we of course don't know what the future holds. Number 2, Main Street Capital, ticker MAIN. This is what's called a BDC, or Business Development Company, which is like a lender to medium-sized businesses, so they then collect the interest and pass that on to you as returns and dividends. And this one has been a standout for reliability because since its stock market debut in October 2007, Main Street has never once cut its regular monthly dividend. Never. Through the financial crisis, through COVID, never cut it. And on top of the regular monthly payout, this will also sometimes pay supplemental dividends like the one in June this year, which was their 19th consecutive one. So counting everything, the yield works out to around 7.7%, and on £1,000, the regular dividend is about £4.70 a month, and with those supplementals, it's historically been more like £6.50 a month. But of course, that could change. But let's talk share price, because over the last year, the share price has dipped about 12%. So recently it hasn't been performing too well in that sense. But over 5 years, including the dip in the last year, the share price has increased by about 34%. And if we zoom out further, historically it has shown a steady upward trend along with a steady dividend. And finally to number 1. By the way, if you do like these kinds of videos, I have tons more of them like it on the channel, so please remember to like this video, then subscribe down below for more. Lastly, we have the highest dividend yield with the Global X Nasdaq 100 covered call UCITS ETF, which is a mouthful, but it's also called by its ticker symbol QYLP, which is currently paying out a very high 11.8% a year dividend yield. Now, this is a covered call ETF, and that means this fund buys the Nasdaq 100, so all the big US tech names, and then it writes or sells call options against them every month. By selling those options, it generates them cash or premiums, and that cash gets paid out to you monthly in the form of dividends. So the trade-off, which is important, is that when the market is surging up, you give up a chunk of that upside, and essentially you're swapping share price growth for dividend income. So to give you a visual example, there is a version of this ETF that doesn't pay dividends, and you can see it has returned around 69%. Nice. But for me, I have it as a portion of my portfolio specifically for that purpose. So on £1,000, historically that's around £10 landing every month, around £118 a year. And because it's a managed ETF, it still has an ongoing management charge of 0.45%. Now, this is built for income, not for growth. Over the past year, the share price itself was up just 5%, but it's mostly flat over the long term, even though the total return, including those dividends, is much higher. The version we get here in the UK only launched in 2022, so it doesn't have a long history, but the original US version has made monthly distributions for 12 years running. So this doesn't tick all the boxes, but it does the job of generating a good monthly income. But guys, that is it for today's video. I hope you enjoyed it. Remember to hit like and subscribe, and I will see you next time, as always, on Casual Cash. Cheers.